Imagine waking up one morning and finding that your bank account is frozen. Not because you did anything wrong, not because of a court order, but because the bank that holds your money made a series of catastrophic bets and lost. Now the entire financial system is on the edge of collapse, and the government, the institution you elected, the one that is supposed to protect you, steps in, not to protect you, but to save the bank. This is not a hypothetical. This happened, and when it did, it revealed something most people had never been forced to confront. In the modern world, banks don't just hold money, they hold power. And in moments of crisis, that power can outrank the power of governments, the will of voters, and the laws of the free market itself. To understand how we got here, you have to understand what a bank actually is, not in the textbook sense, but in the structural sense. A bank is not a vault. It is not simply a place where money sits and waits. A bank is a machine that creates money. When you deposit $1,000 into a bank account, that bank is legally permitted to lend out the vast majority of it, keeping only a small fraction in reserve. The borrower then deposits that money into another account, and the cycle repeats. Money multiplies, credit expands. The economy runs on this system. This process, known as fractional reserve banking, means that for every dollar that actually exists in the real world, multiple dollars exist on paper. It is the engine of modern economic growth. It is also a system that is structurally fragile by design. Because if enough people ask for their money back at the same time, the math breaks down. The money simply isn't there. For most of history, this fragility was contained. Banks failed. Depositors lost their money. Painful, but local. The damage was absorbed by communities, and life went on. But over the course of the 20th century, something changed. Banks grew, they merged, they expanded across borders, across industries, across asset classes. They became so deeply woven into the fabric of the global economy that their failure was no longer a local problem. It was a systemic threat. The first major warming came in 1929. The stock market crash that triggered the Great Depression wasn't just a story about falling stock prices. It was a story about banks. Thousands of American banks had loaned money against inflated assets. When those assets collapsed, the loans went bad. Banks failed by the hundreds. Depositors lost their savings. Credit froze. Businesses collapsed. Unemployment surged to 25%. The entire economic system seized. The response under President Franklin Roosevelt was sweeping regulation. The Glass-Steagall Act of 1933 drew a hard line between commercial banking, the kind that holds your deposits, and investment banking, the kind that makes speculative bets in financial markets. The message was clear. If banks wanted the protection and trust of ordinary depositors, they could not also be casinos. For decades, this separation held, and for decades, major banking crises in the United States were largely contained. The system wasn't perfect, but it had guardrails. Then, slowly and deliberately, those guardrails were removed. Beginning in the 1970s and accelerating through the 1980s and 1990s, a new financial philosophy took hold in Washington. The argument was elegant and seductive. Markets are self-correcting. Regulation stifles innovation. If banks are free to compete, grow, and take risks, the economy will flourish and everyone will benefit. This ideology had powerful advocates. It had think tanks, economists, and lobbyists behind it. And it had money, enormous amounts of money flowing from the financial sector into political campaigns and policy circles. Between 1998 and 2008, the financial industry spent over $5 billion in lobbying and political contributions in Washington alone. This was not investment in ideas, it was investment in outcomes. The outcomes came. In 1999, the Glass-Steagall Act was effectively repealed. Commercial banks could now merge with investment banks. Deposit money could now sit in the same institution as high-risk speculative trading desks. The firewall was gone. Almost immediately, the financial sector began to consolidate at a pace never seen before. Banks that were large became enormous. Banks that were enormous became something else entirely. By the mid-2000s, the six largest American banks, J.P. Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley, collectively controlled assets equivalent to 60% of the entire United States economy. This was the birth of too big to fail, not as a theory, as a structural reality. What does it mean for a bank to be too big to fail? It means the institution has grown so large, so interconnected with other financial institutions, pension funds, insurance companies, and foreign banks, that if it collapsed, the damage would cascade through the entire global economy. Mortgages would freeze, business loans would vanish, international trade would stall. In the most extreme scenarios, ATMs would stop working, payrolls would not be met, grocery supply chains would break down within days. This is not an exaggeration invented by bankers to protect themselves. It is the honest assessment of what financial interconnectedness creates. When everything is linked, the failure of one critical node can bring down the entire network. And the banks knew this. More importantly, they knew that the government knew this, which meant that no matter how recklessly they behaved, no matter how enormous the risks they took, there was an implicit guarantee underneath them. If they won, the profits were theirs. If they lost catastrophically, the government, meaning taxpayers, would be forced to intervene. Economists call this moral hazard. When the downside of a risk is transferred to someone else, the incentive to avoid that risk disappears. The banks were not irrational. They were responding perfectly logically to the system as it had been built. They took the risks because the system told them the consequences would be someone else's problem. In 2007 and 2008, the bill came due. For years, American banks had been issuing mortgages to borrowers who could not realistically afford them. These mortgages were then bundled into complex financial products called mortgage-backed securities and sold to investors around the world. Rating agencies, paid by the banks themselves, blessed these products with top-tier safety ratings. The entire structure was built on the assumption that American housing prices would never fall simultaneously across the country. They did. When the housing market collapsed, those mortgage-backed securities became nearly worthless. Banks that had loaded their balance sheets with these products were suddenly insolvent. Bear Stearns collapsed in March 2008. Lehman Brothers filed for bankruptcy in September. The global financial system went into cardiac arrest. What happened next was one of the most significant transfers of financial risk in human history. The United States government, through the Treasury Department and the Federal Reserve, deployed hundreds of billions of dollars to stabilize the banking system. The Troubled Asset Relief Program, TARP, authorized $700 billion in public money to purchase toxic assets and inject capital directly into failing banks. The Federal Reserve went further. It slashed interest rates to near zero and launched a program called quantitative easing, essentially creating trillions of dollars out of thin air and using them to purchase financial assets, inflating the balance sheets of the very institutions that had caused the collapse. The banks were saved. The bankers, in most cases, kept their bonuses, and the people who had lost their homes, their savings, and their jobs were largely left to manage on their own. The consequences for ordinary people were not abstract, they were measured in foreclosures. Between 2007 and 2012, nearly 4 million American families lost their homes. Another 2 million were in the process of foreclosure. The unemployment rate doubled, retirement savings evaporated, an entire generation of middle-class wealth built over decades was wiped out in less than 2 years. Meanwhile, the banks that had caused the crisis emerged from it larger than before, because when institutions are failing and assets are cheap, the stronger players acquire the weaker ones. J.P. Morgan absorbed Bear Stearns and Washington Mutual. Bank of America absorbed Countrywide and Merrill Lynch. The financial sector consolidated further. The too big to fail problem, far from being solved, had grown. A small number of financial executives faced legal consequences. The vast majority did not. No senior banker from a major Wall Street institution was criminally convicted for their role in the crisis. The Department of Justice reached financial settlements with the banks themselves, essentially fines paid from corporate funds treated as a cost of doing business. The system punished the institution with a fraction of its profits, and the individuals who made the decisions walked free. This outcome was not an accident. It reflected the degree to which the financial sector had become embedded in the legal and regulatory apparatus that was theoretically designed to oversee it. The same banks that needed rescuing had spent years placing their executives in key regulatory positions, funding the think tanks that shaped policy, and lobbying the legislators who wrote the rules. The revolving door between Wall Street and Washington had made genuine accountability nearly impossible. 2 decades after the crisis, the fundamental architecture of the system remains intact. The 6 largest American banks are bigger today than they were in 2008. The financial sector's share of corporate profits has grown. The gap between those who own financial assets, stocks, bonds, real estate, and those who do not has widened to levels not seen since the Gilded Age. New regulations, most notably the Dodd-Frank Act passed in 2010, introduced stricter capital requirements and stress testing for large banks. These reforms were real and meaningful, but they did not break up the largest institutions. They did not restore the separation between commercial and investment banking. And in the years that followed, lobbying efforts chipped away at some of the most significant provisions. The fundamental problem that certain financial institutions are so large and so interconnected that they enjoy an implicit government guarantee was never solved. It was managed, partly restrained, but structurally preserved. What this all means when you step back and see the full picture. We live in an economic system built on the premise that markets are efficient, that competition produces the best outcomes, and that failure is the necessary corrective mechanism that keeps capitalism honest. Businesses that make bad decisions are supposed to fail. That failure punishes poor judgment and rewards careful management. It is the feedback loop that makes the system work. But too big to fail institutions exist outside that logic. They operate in a market where the normal rules apply going up. Profits are private, bonuses are paid, shareholders are rewarded, but do not apply going down. When the losses become existential, the public absorbs them. This is not capitalism. It is a hybrid system in which risk is socialized and reward is privatized. And it is the system we have chosen to build and to preserve. The question this should leave you with is not simply whether the banks are too powerful. The deeper question is why a democratic society has repeatedly chosen to construct a system that gives them that power, protect that system when it fails, and then rebuild it larger on the other side of the crisis. The answer, if you follow the money, the lobbying records, the revolving door between regulators and institutions, and the political contributions that fund the campaigns of the people who write the rules, the answer begins to take shape. Banks did not become more powerful than governments by accident. They became more powerful because, in many ways, the boundary between the two has quietly dissolved. And until that boundary is rebuilt, every crisis will end the same way it has always ended, with the banks standing and the bill sent to everyone else.